In 2007, I made $1 million bet that offended a lot of very smart, very well-dressed people. I said a simple SP 500 index fund would beat a collection of high-fee hedge funds over 10 years. That was not a popular thing to say in rooms full of men who charged 2% to show up and 20% to be congratulated. But I did not make that bet because I wanted attention. I made it because I had spent my entire life watching one expensive illusion trap people over and over again. People think complexity must be superior to simplicity. They think higher fees must buy higher intelligence. They think a man in a tailored suit speaking in a polished voice about macro strategy, downside hedges, cross-asset positioning, and proprietary models must know something the ordinary investor does not. Most of the time, what he knows is how to invoice you. That is the part people do not like hearing. The average investor is trained to believe that wealth comes from finding the genius in the room. What actually builds wealth, more often than not, is finding the system that keeps working after the genius leaves. That is why this conversation matters. When people ask me what could make someone wealthy over a long stretch of time, they almost always ask the wrong question. They ask me for the next explosive stock. They ask me for the company that will double in 6 months. They ask me what ticker can turn a small account into a fortune before patience gets uncomfortable. That is not investing. That is emotional speculation dressed up as ambition. The real question is different. What kind of ownership lets ordinary people keep compounding without needing to predict every winner, dodge every loser, or pay an expert to babysit every decision? That is where exchange-traded funds become so powerful. Not because they are glamorous. Not because they promise drama, because they remove some of the most common ways people ruin themselves. They reduce ego, they reduce friction, they reduce the cost of being wrong about one company, one CEO, one fad, one cycle, one story, one headline, one quarter, one panic. And if you understand how to use the right ones, they can turn your money into a machine that works while you sleep, while you travel, while you age, and while the rest of the world keeps arguing over what will happen next week. When I look at the 3 ETFs with the clearest path to making disciplined people very rich over time, I do not think about them as 3 tickers. I think about them as 3 engines. One is the broad ownership engine, one is the cash flow engine, one is the acceleration engine. Each solves a different problem. Each comes with a different price, and if you do not understand the price, you will not hold them long enough to get the reward. That is where most people fail. They do not fail because they never heard of VU South Carolina HD or QQQ. They fail because they buy them without understanding what job each one is meant to do. Then the market does what the market always does. It tests conviction, it tests temperament. It tests whether you bought an investment or borrowed a slogan. Let us begin with the first one, because this is the one I would hand to the largest number of people if I could only choose one. It is the SP 500 through a fund like VU. Now, the brilliance of the SP 500 is not that it owns famous companies. The brilliance is that it owns successful companies and keeps replacing unsuccessful ones. That sounds simple. It is simple, but simple is not the same thing as weak. In fact, that mechanism is one of the most intelligent structures ever built for the ordinary investor. Most people think they need to identify the future themselves. They think the road to wealth is picking the next winner before everyone else does. That sounds exciting. It also explains why so many people stay poor, because the human being is not built to consistently identify tomorrow as giant before the evidence becomes obvious. And once the evidence becomes obvious, the easy money is often already gone. The SP 500 solves that problem by doing something the average person struggles to do emotionally. It lets the market itself decide who deserves capital. If a company grows, strengthens, dominates, earns, and matters, it rises into the index. If a company weakens, shrinks, loses relevance, or dies, it falls out. That means the fund is constantly pruning weakness and redirecting capital toward strength, not perfectly, not instantly, but systematically. That distinction matters. When I was younger, people could point to companies that seemed immortal. Sears was one of them. There was a time when Sears looked as permanent as the weather. A giant, a fixture. A company people assumed would always be there. If you bought Sears the stock and then refused to think again, you could ride that confidence straight into disaster. That is what happens when you confuse familiarity with permanence. But if you owned the SP 500, you did not have to make that emotional decision yourself. The system made it for you. Sears weakened. Sears lost its place. Sears was removed. Something stronger replaced it. That is what people miss. The value is not just in owning today. S leaders, the value is in owning a structure that removes yesterday. S failures without waiting for you to overcome denial. And denial is expensive. The market punishes denial with great enthusiasm. Look at the long sweep of history, and you see the same lesson again and again. Empires fade, industries turn, consumer habits shift, technology rearranges power, and individual companies that once looked untouchable become case studies in what arrogance sounds like just before revenue disappears. That is why owning a broad index fund is not laziness. It is humility converted into structure. You are admitting that you do not know which one company will dominate 30 years from now. You are also admitting that you do not need to know. You only need to own the system that keeps moving capital toward the winners. That is an enormous difference. In my $1 million bet, that difference was everything. The hedge fund managers had talent. Some of them were brilliant. Some of them probably worked harder than the index fund ever will. But after fees, after turnover, after wrong calls, after partial hedges, after human ego, after forecasting errors, after the endless temptation to do something because doing nothing feels too quiet, the simple system won. Again, that is what fees do. They do not look dangerous when markets are rising. They look like a small percentage, a technical detail, a line item, but compounding treats fees like termites treat a wooden house. A little every year becomes structural damage. A simple low-cost fund like VU lets you keep more of the machine working for you. That matters more than people want to admit. Because once you understand that cost is not a side issue but a central issue, a lot of expensive stories stop looking intelligent. Now, do not misunderstand me. VO is not magic. It will fall. It will frighten you. It will have periods where the news tells you the whole American system is finished. It will make you look foolish to people who just made money on some fashionable niche trade. And then, over longer stretches, it has a habit of outlasting the noise. That is why it works for so many people. It is not built to win every month. It is built to keep you in the game while the economy keeps replacing weak companies with stronger ones. And that leads to the first great rule. If you want millionaire results, you need millionaire patience. People want the returns of ownership without the emotional burden of ownership. They want to enjoy the climb, but outsource the drawdowns. That option does not exist. If you want the broad wealth building power of the SP 500, you have to accept the broad fear that comes with it during bad periods. The fund is simple. Holding it is not. Holding it when everyone around you is explaining why this time is different is where the money is actually made. Now let me take you to the second engine, because the second engine solves a different human problem. VO is about broad growth. SEG is about disciplined cash flow. And cash flow changes behavior. When people talk about dividends, many of them immediately make a dangerous mistake. They chase the highest yield. That is like shopping for a business by asking only one question. How loudly is it promising me money today? That is how people get fooled. A dividend is not proof of strength. A sustainable and growing dividend can be proof of strength. Those are not the same thing. A weak company can pay a high dividend right before trouble becomes obvious. A strong company can pay a modest dividend for years while quietly compounding shareholder wealth with far greater reliability. This is why I care far less about yield in isolation than I care about the quality of the underlying business. A dividend is only as healthy as the profits feeding it, and profits are only as healthy as the business model producing them. That is where SHD becomes interesting. It is not trying to gather every stock waving a high yield flag. It is trying to concentrate on companies with established dividend records and real operating strength behind those payments. That means you are not merely shopping for income. You are shopping for the ability of that income to endure, and ideally to grow. That difference is enormous. Think about a company like McDonald's. as a company at that scale can take profits and do three things: save them, reinvest them, or return part of them to owners. That final part matters more than people appreciate. A serious business that generates serious cash and shares a portion of it with owners creates something psychologically powerful for the investor. You are no longer hoping only for the market to revalue your shares later. You are being paid along the way. For many people, that changes everything. It makes ownership feel real. It turns abstract compounding into visible reinforcement. It trains patience because the business is paying you to stay seated. That is useful because the average person is not defeated by lack of opportunity. He is defeated by lack of emotional endurance. A dividend stream helps certain investors endure. But again, only if the business quality is there. This is where the strongest dividend funds separate themselves from the traps. SageD tends to lean toward companies that sell products and services the world keeps buying in ordinary times and difficult times: energy, healthcare, consumer staples. Industrial and established businesses with durable cash generation, not glamorous, not the loudest names at the cocktail party, but that is the point. A great deal of wealth is built in places that do not feel exciting enough for television. That is one of the market's least popular truths. Excitement and reliability usually do not live in the same neighborhood. If you want a fund that can help create an income stream over time, especially one tied to businesses with real profits, real cash discipline, and a record of paying owners, South Carolina HD gives you a framework for that. Now, it is not a bond. It is not guaranteed. It can and will decline in major market downturns. Anyone who sells a dividend fund as if it cannot drop is either confused or selling confidence for a living. The share price can fall. The market can punish everything for a season. But the philosophy underneath it is sturdier than people think. You are owning companies that have already shown a willingness and an ability to return profits to shareholders year after year. That matters because dividend growth is often a quieter sign of strength than headlines. A business that can steadily raise what it sends to owners is often telling you something about margins, pricing power, discipline, and durability. That is the second great rule. Do not buy income that is starving. Buy income that is fed by a strong business. Most people reverse that rule. They look for the fattest payout and then ask questions later. That is upside down. I would rather own a stronger company with a healthier dividend culture than a weaker company making desperate promises. Desperation has ruined more investors than bad luck ever did. What I also like about a fund like SageD is that it can become a bridge between the paycheck life and the ownership life. A lot of people struggle to think like owners because their entire financial identity is built around labor work. Get paid, repeat work, get paid, repeat. That model trains the mind to believe income must arrive only when effort is immediate. Dividend investing begins to crack that belief. Now the question becomes different. What can I own that pays me because it is productive? Not because I showed up this morning. That mental shift matters. It teaches ownership, it teaches patience, it teaches the investor to respect business quality. And for retirees or near retirees, it can also create a sense of financial rhythm that feels less dependent on selling shares into whatever market mood happens to exist this quarter. That is not trivial. Peace of mind is a legitimate part of portfolio design, not the only part, but a real part. Now let us move to the third engine, because this is where the promise gets bigger and the emotional cost gets much higher. QQQ is the acceleration engine. It gives you concentrated exposure to large non-financial companies, which in practice means heavy technology exposure. This is the fund for people who believe correctly, in my view, that technology will continue to reshape productivity, spending, communication, commerce, entertainment, infrastructure, and daily life for decades to come. That belief has made people very rich. It has also broken people who confused a strong long-term thesis with a smooth ride. QQ is not built for smooth rides. It is built for velocity. And velocity cuts both ways. When technology is being rewarded, QQ can look magnificent. It can make diversified funds look sleepy. It can make patient investors feel brilliant. It can create the impression that maybe concentration is the superior path after all. Then the cycle changes, rates rise, speculation breaks, valuations compress, narratives collapse, and suddenly the same investors who were calling themselves visionaries begin asking whether they should have sold months earlier. That is what concentrated growth does. It amplifies both conviction and regret. The reason QQ has produced such powerful results over many stretches is not mysterious. Technology has absorbed an extraordinary share of modern economic value. The world digitized, then it connected, then it accelerated. Software spread, cloud systems spread, digital advertising spread, artificial intelligence spending accelerated, data became infrastructure, computation became power. And companies sitting near those streams captured enormous profits and investor attention. If you owned a fund concentrated in the larger non-financial innovators and beneficiaries of that shift, you participated in one of the great wealth waves of the modern era. But here is the toll: you have to live through the drawdowns. And the drawdowns are not polite. During the bursting of the dot-com bubble, the NASDAQ was crushed. People remember the wealth created by technology. They forget the punishment technology investors took when the market decided it had become too enthusiastic. A fund like QQ can fall far harder than the broader market because the same concentration that produces spectacular upside can produce spectacular downside. That is not a flaw. That is the bill. You do not get acceleration without accepting instability. That is the third great rule: never buy volatility by accident. If you own QQ, know why you own it. Know what it is for. Know what it can do in a panic. Know what you will do if it falls 30%, 40% or more. Because if you only love it in a bull market, you do not own it. You are renting a feeling. And rented conviction expires exactly when the price gets painful. Now, do I think technology will matter more 10 years from now than it does today? Yes, I do. I think that is a reasonable long-term judgment. But the market is not a machine that rewards reasonable long-term judgments on your preferred schedule. Sometimes it overshoots. Sometimes it underprices. Sometimes it turns an obvious long-term truth into a terrible short-term entry point. That is why discipline matters more with QQQ than with the first two engines. The investor who uses QQQ well treats it as aggressive growth exposure, not as a personality. He does not build his whole identity around it. He does not assume last decade's returns are a contract for the next decade. He does not panic when the volatility he was warned about finally arrives. He understands that concentrated growth is a powerful servant and a dangerous master. Now, if you put these three engines side by side, a deeper lesson appears. VO is the ownership of broad American strength. CAG is the ownership of disciplined profit-sharing businesses. QQ is the ownership of aggressive innovation and technological acceleration, growth, income acceleration, broad strength business quality, future intensity. Each one answers a different question. VU answers, how do I own the winners without needing to identify them one by one? SEG answers, how do I build an income stream from companies strong enough to keep paying owners? QQQ answers, how do I lean into technology without pretending it will come without violence? Those are not interchangeable jobs. That is why mature investors stop asking which fund is best in the abstract. They ask which role needs to be filled in their financial life. If a young investor with decades ahead of him wants a simple and durable base, VU is a very intelligent answer. If an investor wants more income orientation and more exposure to strong dividend culture, South Carolina HD has a role. If an investor wants to add aggressive growth tied to technology and accepts the emotional burden that comes with it, QQQ can have a place. The mistake is not choosing any one of them. The mistake is choosing one for the wrong reason. People buy VU and then complain it is boring. Boring is part of its virtue. People buy SHIG and then complain it is not the hottest thing in the room. That misses the assignment completely. People buy QQ and then act surprised when it behaves like a volatile technology-heavy growth vehicle. That is like buying a racehorse and being upset that it is hard to park in your garage. You must understand what you bought. That is half the battle in investing. The other half is staying put long enough for the structure to work. Let me say something even more direct. These funds do not make people millions by existing. They make people millions when the investor combines them with behavior that most people find unpleasant: regular buying, cost discipline, patience, emotional control, refusal to chase headlines, refusal to quit during drawdowns, refusal to confuse temporary price damage with permanent impairment when the structure remains sound. There is no ETF powerful enough to save a person from bad habits that is worth remembering. A wonderful fund in weak hands produces disappointing outcomes. An ordinary fund in disciplined hands can produce extraordinary outcomes. That is because the hidden engine is not only the ETF, it is the investor's conduct. This is where compounding becomes moral before it becomes mathematical. Can you keep showing up? Can you keep buying when the world feels ugly? Can you avoid chasing the latest thing because someone on a screen looked excited? Can you resist turning every portfolio into a referendum on your intelligence? Can you let time do the heavy lifting instead of demanding fireworks every quarter? If you can, these tools become powerful. If you cannot, you will probably sabotage even the best structure. And that brings me back to why the average person struggles. He wants to look rich before he becomes rich. He wants the vocabulary of an investor before he earns the temperament of one. He wants to tell people about the next 10-bagger. He does not want to tell people he quietly kept buying a broad index fund for 15 years. But the second story is closer to how real fortunes are built. Not all fortunes, but many of the durable ones. Now, if I were speaking to someone trying to turn a lifetime of effort into serious wealth, I would say this: start with clarity. Know what you need each engine to do. If you need a broad ownership base, respect VOO. If you need a disciplined income machine, study SHD. If you want more aggressive technology exposure and can truly endure the punishment that comes with it, then QQQ may deserve a measured place. But do not worship any of them. Use them. Do not ask one fund to solve every problem in your life. Do not pretend a high-return vehicle must also be emotionally easy. Do not pretend an income fund must behave like a technology rocket. Do not pretend the broad market must entertain you. Investing is not entertainment. It is capital allocation in service of your future freedom. The final mistake I want to warn you about is this one. People think millionaire results come from choosing the perfect product. Usually they come from choosing a good enough product and then behaving with uncommon consistency. That is less exciting. It is also much more useful. I have met many people who spent years searching for the perfect investment while failing to build the perfect habit. They delayed ownership because they wanted certainty. The market charges a brutal price for that. Time is the one asset you cannot replenish. You can recover from a market correction. You can recover from buying a reasonable fund before a downturn. You can recover from underperformance in one period. What you cannot recover from easily is spending 10 years standing at the edge, mistaking endless preparation for prudence. At some point, the threshold arrives. You either decide to become an owner or you remain a spectator. That is the real dividing line. Not IQ, not income, not whether you can pronounce macroeconomic jargon, whether you are willing to live as an owner long enough for ownership to transform your life. So here is the contract I would make with myself if I were building from scratch today. I will not confuse complexity with superiority. I will not overpay for somebody else. S story. I will not chase yield without business quality. I will not buy growth without accepting volatility. I will not demand certainty from an asset class that has never promised it. I will choose simple structures that can survive my moods. I will keep costs low. I will keep expectations realistic. I will keep buying through discomfort. And I will measure progress in years and decades, not headlines and weekends. That is how these 3 ETFs can make people millions. Not because they are magic, because they make disciplined behavior easier than scattered stock picking, easier than expensive guessing, and easier than trying to outsmart every cycle. The broad engine, the cash flow engine, the acceleration engine used correctly, they can turn labor into ownership and ownership into freedom. Used carelessly, they will simply expose the same impatience, that ruins every other strategy. The choice is not between 3 funds. The choice is between 2 identities, the person who wants a thrilling story and the person who wants a compounding machine. Only one of those people usually gets rich.